Dear students, myself Naresh Kumar Dogra, Senior PGT Commerce, Army Public School, Udhampur. Earlier we had discussed financial statements of a company. Now, further we will discuss heads and contents of a balance sheet of a company. The balance sheet of a company is divided into two sections. Section 1, Equity and Liabilities. Section 2, Assets. Now, firstly, in the equity and liability section, equity is the liability towards shareholders and it is termed as shareholders' funds. Shareholders' funds includes share capital, reserves and surplus, and money received against share warrants. And liabilities means external liabilities of the company, that is, liabilities towards the outsiders of the company. The contents of the balance sheet in each section are divided into major heads and subheads. So in section 1, equity and liabilities, the first major head is shareholders funds. Shareholders funds are subclassified on the face of the balance sheet as share capital. This is what the subhead. Share capital means amount received by the company against share issued for subscription. The persons to whom shares are allotted are known as shareholders. And share capital is further classified into authorized capital, issued capital, subscribed capital. And subscribed capital is further subdivided into subscribed and fully paid up and subscribed but not fully paid up capital. Second subhead is reserves and surplus. Reserves means amount set aside out of profits and surpluses to meet future uncertainties. Prospective losses are to strengthen the financial position of the company. Reserves and surplus are required to be classified as capital reserve, capital redemption reserve, securities redemption reserve, debenture redemption reserve, revaluation reserve, share options outstanding account, other reserves, and surpluses, that is balance in the statement of profit and loss. And the third subhead is money received against share warrants. Share warrants give the holder right to acquire equity shares at a specified date and at a specified rate. These are financial instruments which will be converted into equity shares at a later date at a predetermined price. Since these are to be converted into equity shares, these are shown as shareholders' funds. Second major head is share application money pending allotment. Basically, it is a line between shareholders' funds and non-current liabilities. Amount received by the company towards share application and against which the company will certainly allot shares in future is shown against share application money pending allotment. This situation will arise only when the allotment is made after the balance sheet date, that is 31st March of that particular year. Third major head is non-current liabilities. These are defined in Schedule 3 of the Companies Act 2013 as those liabilities which are not current liabilities. Now, as per Schedule 3 of the Companies Act 2013, these liabilities are having certain subheads like long-term borrowings. Long-term borrowings means amount taken as loan by the company through the issue of debentures, loan from banks or private lenders, public deposits or of any other nature, repayable after 12 months from the date of the balance sheet. Second subhead under non-current liabilities is deferred tax liability net. Every year the accounting income is compared with the taxable income. If the accounting income is more than the taxable income, then the income tax payable on that difference is termed as deferred tax liability. Third subhead is other long-term liabilities. Those liabilities that are other than the long-term borrowings are termed as other long-term liabilities. For example, trade payables on account of purchase of fixed assets and interest accrued thereon, etc., if payable after a period of 12 months. Fourth subhead is long-term provisions. Provision is the amount set aside to meet the future liability, the amount of which cannot be determined accurately, what it is estimated. All provisions for which the related claims are expected to be settled beyond 12 months after the balance sheet date are classified as non-current provisions. For example, provision for gratuity, provision for warranty claims, etc. Fourth major head is current liabilities. Current liabilities are defined in Schedule 3 of Companies Act 2013 as liability which is due to be settled within 12 months from the date of the balance sheet, and it should generally be a trading liability. Various subheads under current liabilities. Short-term borrowings. Short-term borrowings are those which are due for payment within 12 months from the date of the balance sheet. These includes loan repayable on demand, bank overdrafts, etc. Second subhead under current liabilities is trade payables. Trade payable refers to the amount due to be paid on account of goods purchased or services received in the normal course of business. It includes sundry creditors and bills payable. Third subhead is other current liabilities. All current liabilities excluding short-term borrowings and trade payables are other current liabilities. For example, current maturities of long-term debts. Fourth subhead is short-term provisions. These provisions are the provisions for liabilities which are likely to be paid within 12 months from the date of balance sheet or within the period of operating cycle, whichever is longer. For example, provision for doubtful debts, provision for expenses, provision for tax, etc. Section 2 of the balance sheet consists of the assets. Assets are the belongings and possessions of the business, like liabilities. Assets are also divided into two major heads: non-current assets and current assets. Non-current assets are defined in Schedule 3 of the Companies Act 2013 as those assets which are not current assets. Various subheads under the non-current assets are: first is fixed assets. Fixed assets are those assets which are held by a company not for the purpose of resale but for the purpose to increase the earning capacity of the business. Fixed assets includes tangible fixed assets. These are those assets which have physical existence and they can be seen and touched, for example, land, building, furniture, etc. Intangible fixed assets. These are those assets which do not have any physical existence and thus they cannot be touched and seen, for example, copyrights, etc. Capital work in progress refers to those fixed tangible assets which are under construction, such as building, plant and equipment, etc. And intangible assets under development includes patents, copyrights, etc., which are being developed by the company. Second subhead under non-current assets is non-current investments. These are those investments which are held by a company for a period of 1 year or more, not with the purpose of selling but to retain them. These are classified into trade investments and other investments. Third is deferred tax assets net. Every year the accounting income is compared with the taxable income. If the accounting income is less than the taxable income, then deferred tax assets comes into force. Fourth subhead is long-term loans and advances. Long-term loans and advances are those that are expected to be received back in cash or kind, that is, in the form of an asset after 12 months from the date of balance sheet. Fifth, other non-current assets. All other non-current assets which do not fall into any of the above classification are shown under the heading. These may include trade receivables to be received after 12 months, unamortized expenses like share issue expenses, etc. Second major head is current assets. Current assets are those that are expected to be realized within 12 months from balance sheet date and are held primarily for the purpose of being traded. Current assets are subdivided into 6 subheads. Number 1, current investments. These are those investments by the company which are held to be converted into cash within a period of 12 months from the date of purchase of these investments. Second is inventories. Inventories means stock of goods held for the purpose of trade in the normal course of business, including stock of raw materials, work in progress, finished goods, etc. Third is trade receivables. These are the amounts receivables for the sale of goods or services rendered by the company in the normal course of business within a period of 12 months. Fourth is cash and cash equivalent. Schedule 3 requires that cash and cash equivalents should be classified as balance with bank, checks or drafts in hand, cash in hand, and marketable securities. Fifth is short-term loans and advances. These are those loans and advances which are expected to be realized within 12 months from the balance sheet date. Sixth, other current assets. These are all other current assets that do not fall in any of the above classified categories. These includes prepaid expenses, accrued incomes, etc. Now, contingent liabilities and commitments. These are those liabilities which may or may not arise because they are dependent on an event happening in future. For example, a claim is filed against the company in a consumer court by a customer. Contingent liability is not recorded in the books of accounts, but it is disclosed in the notes to accounts. Commitments means financial commitments due to activities agreed by the company to be undertaken by it in near future. For example, contracts remaining to be executed. Now, few home assignments. You will have to show under what heads and subheads the various items will appear in the balance sheet of a company as per Schedule 3, Part 1 of the Companies Act 2013. Thank you.